Hey there, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. In a rainy Redmond, Washington, it's Wednesday afternoon. We're looking at a day when markets sort of opened and traded higher, closed more lower. The S&P just narrowly staying in the green, but the Dow, the mid caps, small caps, all in the red. Volatility pushing a little bit higher, but still incredibly low relative to long-term levels. So we're sort of in that familiar bucket where the growthy stuff, things like Netflix pushing to the upside, moving onward and ever upward, as they say. Some of the other areas of the market just struggling and pushing to the downside. At the end of the day, we have a divergence in a lot of cases between narrow leadership and the rest of the team. How does this resolve? We're going to look at the charts together and also talk with a great guest today, John Kosar of Asbury Research. He'll share his Asbury Six model, looking at some of the macro inputs, talk to us about some of the areas where he's seeing opportunity and how he manages risk in this sort of environment. With that in mind, let's get right to our market recap and look at how the charts evolved. Before we get to the charts, I do want to start with a poll. We asked you recently, very simply, what's more important to you in your process, fundamental or technical analysis? About 52% of you said technical analysis. So the good news is you're definitely in the right place looking at Stock Charts TV and hopefully using the Stock Charts platform because that is really where we are focused. About 15% of you said you're primarily focused on fundamental analysis, and I've spent much of my career working with fundamentally oriented investors, helping them think about how to use technical analysis to complement their fundamental thesis and their macro point of view. So I think the marriage between fundamental and technical is really ideal, and that's why 33% of you saying about the same. I think that's a fantastic way of thinking of it. A number of experts, William O'Neill, of course, comes to mind, and others have popularized what we call fusion analysis. John Palika is a fellow CMT who wrote a book, I think, called Fusion Investing or something with the word fusion in there, talking about the combination of fundamental and technical. Really, the O'Neill methodology is driven by that combination of companies and stocks and how they're related, but they're very different. And thinking about the evidence of price in the form of technical analysis, evidence from the company or insights from the company in the form of their quarterly filings, using those together, pretty powerful combination. I hope you can combine those methodologies and really focus on the benefits of the technical side of the equation here on Stock Charts. With that in mind, let's get to our continue with our market recap and look at some of the returns today. As I mentioned, the S&P is sort of narrowly finishing in the green, but just narrow, 0.1% higher. So at the end of the day, we're at 48.69, just below that. The Dow is actually down 0.25%. The NASDAQ composite slightly higher, about 1/3%. Look at mid caps and small caps, both in the red. And again, market bulls will tell you this just completely does not matter. And I don't want to denigrate a very fair point of view, which is if the market's going up, the market's going up, right? And whether we debate what should be happening or why it should be happening, at the end of the day, an uptrend is an uptrend. And I 100% agree. And I would say charts that are going higher should be trusted, and you want to continue to follow those trends until the evidence tells you otherwise. But in my years of training, seeing the market in an uptrend and small caps deteriorating along with mid caps doesn't feel particularly great to me, because for most of my career, mid caps and small caps need to be a part of that. But it really speaks to how when we think of narrow leadership, we're really gravitating toward sort of the safety trade. I would argue one of the great safety trades are technology and semiconductors and communication services. These are companies that certainly give the implication that they're going to be around for quite some time. Netflix spiking in subscribers certainly suggests they're going to be around for a little while. So go with what's working, and that's certainly where we're seeing things work. Volatility increasing slightly, right? The VIX back above 13, but again, 13 is still in the low teens. That's a relatively low level. Back of the envelope for me is above 20, is a high volatility environment. So we've been in a low volatility environment for a number of months now. So, until that changes, this is sort of a slow and steady grind higher. And that's what it is. It's a grind higher, which means you assume the path of least resistance is up, and you look for evidence that a turn or a change may be happening. We're definitely seeing rates continue to push to the upside. So it's interesting as we are setting the stage for the first Fed meeting of 2024, which will be next week, end of January, and no change expected there by most experts, including me, in terms of Fed policy. But many, and myself included, will be hanging on conversations about projections of what the Fed will be doing through the course of 2024. I think in a lot of ways that will be the game in 2024 is anticipation or expectations about what the Fed does, the Fed's actual timeline of rolling those out, and then when we start to look forward to when rates start or when they start lowering their target rate, what sort of end we have in mind down the road. Those are going to be the questions here. Bond prices, of course, moving lower when rates are going higher. So the TLT down about 0.6%, the dollar index down about 1/3%. Looking at the commodity space, we have gold, the GLD down slightly 0.8%. Everything else in the green. Crude oil, natural gas, copper prices all up. By the way, we are going to do a mailbag show later this week. One question that did come up, the UNG seemed to spike from 5-something to 20-something overnight. And if you think you're dreaming and you pinch yourself, it's not just you. There was a 4-for-1 split that happened. And so basically the price quadrupled from 5-ish to 20-ish. No real change in the structure of natural gas. And we at Stock Charts use adjusted data. So when you bring up the chart of the UNG, it's going to look like it's been in the 20s for quite some time because you adjust for splits and you sort of normalize it to the new end result, or the new value, which is common practice in the industry. But that is what happened. That was not a huge spike in crude oil or in natural gas where it went up 300% or something. That was just a split that occurred earlier this week. Finally, cryptocurrencies. You can see Bitcoin, Ether prices both in the red. The rest of the top 10 coins sort of mixed, to be honest with you. Sort of a small move relative to what we've often seen with Bitcoin. You know, I'd highlight on the chart of Bitcoin, we just continue to revolve around big round numbers. And that's something that I've learned over years now of studying Bitcoin from a technical perspective and focusing on support and resistance. More often than not, big round numbers end up being have a significant meaning. Call that a pivot point, right? A level at which the market tends to reverse just because, and you'll see that with Dow 10,000, Dow 100,000, which at some point probably comes to pass. S&P at 4,000 or 5,000 or 10,000 or 1,000 all become pretty meaningful. So Bitcoin 40,000, just one of those big round numbers where you often expect some reversals, and we're certainly seeing some choppiness yet again today. Look at this, energy at the top of the list here, which has not happened very much recently. A lot of the energy sector pretty beaten down on a relative basis, has been very underwhelming. When I've talked with Julius DeKempener recently looking at the RRG on the daily and weekly, even the monthly RRGs, energy not a particularly strong component of any sector rotation. It's certainly been on the weaker side on a tactical time frame, also on a sort of longer term time frame. But today, mean reversion to the upside. The XLE was up 1.5%, and that'll put it to the top of the leaderboard, followed by two of the FANG sectors, the XLK and the XLC, both up about 0.6, 0.7%. On the downside, note a number of sectors actually down over 1%. Utilities, real estate, two very defensive sectors, materials, and then consumer staples. So 3 of the 4 that lost value today, really the most defensive sectors that I would list out of the 11. So today, to generalize, offense over defense, continuing to be large over small. Those are themes that have been around for quite some time, I think continuing to be observed here today. Let's go to a daily chart of the S&P 500. Just look at where we're at here. So, interesting that we opened higher but closed at the lows of the day. And it's not the end of the world when we close at the lows of the day. But if you think a lot of candle patterns, I don't know if I would assign this particular day a specific, that's not the one I wanted, not a specific candle pattern. If you think you do see one, drop a comment and let me know. I don't think I would call this, I'm certain I wouldn't call this a shooting star candle. You might be tempted for that. The reason why I wouldn't is because a shooting star candle has a long upper shadow and very little lower shadow, just like this one, but the open and close need to be near the lows of the day. And we actually opened mid-range for the day, so that kind of negates it being any sort of that kind of candle, like a doji, where the open and close need to be very close to one another. So I think I'd call it a down close. But, so a lot of candle patterns, like bearish engulfing patterns and dark cloud covers and shooting star candles and a lot of things involve closing near the lows of the day, and that's an important component, right? We open, we trade around, but then we close at the lows. So while this isn't a particular candle pattern, the fact that we close near the lows of the day is not a particularly bullish moment in time. Now, again, this is one moment. This is one day, so let's look to see how things play out. But certainly suggesting that people sold into that rally going up to 4,900 and pushed the S&P down almost to what we'll call 48.68. going into the end of the trading session. It's interesting. I was looking on an intraday basis. This is just looking at the last week or so. So I'm looking at a 5-minute chart. We don't show these too often on the channel, but just to show you, here's that gap at the open. Here's trading higher into we'll call it the lunch hour, and then the afternoon was just pretty much all to the downside. Now that's yesterday's close, so you can see we finished narrowly above that. Now compare that to something like small caps, where we opened at yesterday's open. We traded down to yesterday's close and bounced. And this is why short-term traders, day traders, often pay attention to what happened the previous day, because look at this. Yesterday's open, yesterday's close coming very much into play. The first half of the day was really barriered by those two extremes. But then we did this thing right here, right after 1 p.m. Eastern. We broke down below yesterday's close, and the rest of the day was in a period of distribution. So certainly the afternoon was not a particular warm and fuzzy bullish feeling. It was more about distribution as the market was making a push to new highs earlier in the day. I do want to show one breadth chart. We hit on breadth pretty commonly, but I just wanted to point out on the percent of stocks above their 50-day and their 200-day. Again, this is when I'm thinking of conditions that I can observe. This one chart really summarizes the breadth conditions, because the general way that I would think of breadth right now is long-term bullish, short-term bearish. And this chart sort of combines the two of those. Adam Turnquist from LPL Financial was on our show last week or the week before, I forget, but he talked about thinking of this relationship between breadth time periods, and we're looking at a similar chart. And his point, which I would 100% agree with, is the fact that most stocks are above their 200-day moving average, and as long as that continues, so for me, 50% is kind of the basic level I would look at. The long-term trend is good, because just like the S&P is really far, it's about 10% away from its 200-day moving average in red, most stocks are still above their 200-day as well. Very few have broken down through their 200-day. Only about 10% of the S&P in the month of January. So, overall, conditions long-term pretty good. But in the short term, we became very overextended at the end of last year, and those levels are all starting to come down. The bullish percent indexes, which were extremely high, still above 70%, but right at that threshold. The percent of stocks above their 50-day moving average coming down from 90% to almost 70%, which means 20% of the S&P have broken their 50-day moving average in the month of January. That's not a bullish confirmation by any means, right? That tells you that even though the benchmarks are moving higher, individual stocks are failing to do so. And for me, that's a bit of a warning sign. So we'll see how things play out. We'll continue to monitor that, but that's something I would certainly encourage you to pay attention to. Let's see, with the time we have left, where are we going to go here? I say we go to crude oil and gold. I just want to check in briefly on these because energy at the top of the list today. So I've mentioned a number of times, I think energy is a bullish opportunity if and only if you think crude oil prices are going higher. And the reason for that is because that tends to track pretty well, right? Energy stocks do well when crude oil prices are going up. They tend to not do well, particularly on a relative basis, when crude oil prices are going down. And that's really, it's a macro call in a lot of ways, looking at names. Pipelines are a little different, which are in there because those are more slow and steady gainers and high dividend payers. But other things, when you think about E&P, exploration and production stocks, integrated stocks, and so forth, they're basically tied very much to the price of crude oil. Now, I would observe the technical configuration of crude oil as still neutral, and I would say it's a downtrend, October, November into the December low. From there, it's been what I would probably describe as a coil pattern of lower highs and higher lows. We're right at that point where you could argue we're breaking out of that coil pattern to the upside, and I think that's why this is a key chart to watch, right? Things that I would want to see would be breaking out of this coil pattern, certainly following through above the December high. If we took out the 200-day moving average, that would be great because we've been below it. We've been below it since the beginning of November. The RSI, would want to see that continue to push higher because an RSI above 60 in an uptrend is more characteristic of a bullish phase, similar to what you saw like in July and August of last year. So overall, we're kind of right almost there, but not quite to the point that this is a clear uptrend like you saw right in the summer of 2023. Another chart I'll show you is gold, and gold is an important chart. Number one, if you zoom out and look at like a monthly chart of gold, you'll see we're really at the upper end, long time, in all-time gold prices. We're kind of up there at the upper end of a multi-decade range. So gold is at a pretty nice run here in recent years. We are now sort of stalled out at the all-time highs. We got up to around 2140, 2150, and now have come back down, and $2,000 an ounce, again, a big round number, very much in play. This is where we found resistance in July and October of last year. We broke out in November, found support in December, found support again here in the last week or two. So I think holding $2,000 an ounce is pretty important. You can see the 200-day moving average not too far below there, around 1980. So we're kind of right at that point where if gold is a constructive chart, which I think it is, the momentum is still pretty constructive, I would say this is the point where you'd probably expect it to bounce. And if not, if we start breaking 2,000, certainly if we break the 200-day moving average is how we say that. We break below that one, then I would be concerned about the likelihood of further upside for gold. I'd be thinking more defensively in that particular commodity. With the time we have left in the market recap, let's look at some names. Of course, big story today, biggest gainer in the S&P, Netflix, gapping higher almost 11%. It was up over 560 earlier today, settled down to close around 545. This is after bouncing off of the 50-day moving average. This is one of the only two of the Magnificent Seven stocks that had not made a new significant high. That's not true. 3, right? Apple's still kind of below there. Netflix below there until today. Tesla, of course, reporting earnings. We'll look at that a little later, sort of at the lower end of the range as well. But a nice gap higher. What's interesting is they actually technically missed earnings, but subscriber growth and a lot of the qualitative commentary that they included in the call really gave investors some optimism. So, again, anytime you have a gap higher like that, I always think the next day is super important. Are investors selling into this strength and thrilled to take a profit on Netflix, or are they so optimistic that they're willing to buy even more, even though this thing has gapped higher, 70 points in the last 24 hours? So the rest of this week, I would say pretty key. Textron is another earnings name. You can see gapping higher. They're reporting today as well. Aerospace is kind of mixed. You have Boeing in there, which is obviously a pretty challenging chart given the situation that's happened recently, yet again with the 737 MAX aircraft. But you are seeing a gap from 80 up to 82, closed higher, right? So traded higher through the course of the day. So buyers coming in at the open and continue to push higher. So while the S&P closed back at the lows, a stock like Textron is closing near the highs. That's obviously much more of a bullish short-term sentiment reading. You'll notice as I'm updating my charts, this big green headline at the top of my screen. I wasn't kidding when I told you I'd be setting some alerts based on some of the levels that we're talking about. The level that I asked stock charts to trigger me on was ITB crosses below 97.50. And you go to my alerts page, it'll tell you in the text there what the alert was for. And it basically, spotted this bearish momentum divergence, higher highs in price, lower peaks of momentum. So I wanted to know if we were able to hold that low from early January, right around 97.50. We briefly traded below it, and my alert was triggered this afternoon, and it was fantastic. Got my cell phone as well. I immediately looked at the chart right as I was getting ready to prepare for I was in the middle of preparing for the show, and noted the fact that we're there. So it's not really the end of the world yet. I would love to see, or I guess I'd be interested to see if we are able to hold that level. Now that we kind of closed right there, do we hold that? Do we hold the 50-day? Those would be the questions I would be looking at. A lot of other stocks reporting earnings, including IBM, Tesla, some big market cap names are represented. Make sure you use the earnings calendar on stock charts to keep track of all the important names important to you that are reporting earnings this week. That's it for our market recap. I'm going to bring on today's guest, John Kosar, in a few moments. Before we do so, just a quick reminder, we love hearing from you. We had a lot of fun with the mailbag recently, some really thoughtful questions. I would encourage you to send your questions, anything related to technical analysis, related to the stock charts platform, particular technical indicators or tickers that you're trying to make sense of. We're here to help. thefinalbar@stockcharts.com is our email. We're on X @finalbarsctv. And here on YouTube, of course, just drop a comment below the video that you're watching. We'd love to hear from you. We'll hope to feature one of your questions in our next mailbag episode. And now I want to bring on today's guest, John Kosar. John's the founder of Asbury Research, coming to us once again from Chicago. John, Happy New Year. Good to have you back on the show.
Good to see you, and Happy New Year.
To you as well. We were talking before we started recording here, just what an unusual market this is. You've been doing this for a couple of years, I know. Talk to us about what makes this particular environment so unusual, so different compared to your experience through different market cycles.
Well, I think the first thing that jumps to me is the Asbury Six, which is our daily measure of what the internal health of the market is. Normally, when you have this sort of a rally that we've had, where we're making fresh highs, new all-time highs in many cases. You see the Asbury Six all green, and right now we're 50-50. We are, 3 of them are green and 3 are red, and the red ones are the investor asset flows into SPY, or the AUM that's in SPY, the ETF that tracks the S&P 500. Then you've got trading volume and you have market breadth. So that tells me that there's parts of the market that are doing great, which we're looking at a narrow piece of technology. The AI names are doing well, but you're not seeing that in the broad market. If you look at the S&P 500 that is in cap weighted, we have not made new highs. I noticed that the shares outstanding since the end of last year have actually gone down about 5% in SPY. So it's unusual that it's narrow, but it's strong enough that it's dragging everything up right along with it.
It's so interesting. I mean, we've obviously seen that phenomenon in recent years. There's stretches where the mega cap names can drive the the benchmarks higher, but kind of everything else is struggling it. When you think about Q1, seasonally weaker part of the year, how important is it to start to see participation from mid caps, small caps? Even the Dow finished in the red today after starting in the green. How important is it to start to see some agreement from other areas of the market?
Well, that's tough to say, because through a large part of last year, people kept saying the market can't keep doing this. The market can't keep going up. It can't be this narrow and keep pace with how well it's been doing. And look, we're at new all-time highs in the S&P 500. So I don't know. I think it's more important to watch what's going on with some indications of fear. The VIX is one that I think is probably the most fast twitch of all the tactical metrics that I watch. So we've got the VIX here down underneath, going back to October of last year, and the S&P 500 up top. And what that's showing is that you've got this narrow range in the VIX since right before Christmas, 1450 up top and 1181 down on the bottom. Note how many times we touched that 1450 area. We even got through it intraday for maybe a day, day and a half tops. So for me, the question is not how long can this narrow group keep driving prices higher until the cavalry comes, right? Until the mid caps and the small caps come, but rather how long can the market keep going higher without getting spooked by something? And that's I think what you're going to see if we get the VIX over 1450. As long as the market stays cool and calm, I don't want to bet on when this is going to end. I think it's going to end sometime this quarter, but you got to wait till the market is afraid enough to facilitate a move down. We're not there yet.
I love that way of describing it. It's a great point, John. I mean, a narrow uptrend is still an uptrend, right? So we're seeing prices go higher, but volatility remains low. I think that's a really good point to make. Another chart that you shared with us beforehand was just looking at a sort of longer term chart, thinking about the momentum and by the measure that you're showing us, sort of an overbought condition for the S&P. Can you talk us through this chart, what it's telling you about the conditions here?
Sure. And just by the way, you're seeing this in investor sentiment as well. We look at probably half a dozen different investor sentiment indexes, and they're all up where historically you're in the neighborhood of a top. So what we've got here is a quarterly overbought, oversold down in the bottom, going back to latter part of 2018, and the S&P 500 up top. This happens to be a 63-day relative strength index. So what you see here is, with exception of 2021, where you can see a lot of activity up in the overbought area, that's when the Fed had its foot on the gas. It had its whole body on the gas, right? Trying to get the market out of the doldrums from, the COVID situation. But every other instance here, we got September 2018, Jan of 2020, Sep of 2020, July of last year, and now. So this is not a tactical tool that tells us to sell the market right now, but it tells us, historically speaking, this is generally where you start seeing a peak emerge. It could be weeks early, but it does tell us that based on history, which is all we've got because we can't see the future, this is a place where you need to be on your toes and start kind of having your ear to the track and looking for stuff like the VIX starting to get elevated, starting to see money moving out of some of the key ETFs, like the Qs have been, money's been pouring into the Qs hand over fist here for the past several weeks. We start to see that start to back away a little bit. That'll be another indication for us that maybe we're ready to go into a corrective phase.
So it's interesting. The market obviously saw a lot of strength in November, December, coming off of that October low, which seasonally makes a ton of sense. That's pretty common in the last couple months of the year. The Q1, right, the first quarter of an election year actually tends to be a lot weaker. How much does seasonality play into your thinking when you're observing all these conditions? Is it something you would use in tandem with some of these other metrics, or is it more focused on the evidence the market's providing in the form of price?
To me, seasonality is it's tertiary. You know, you and I have talked about this before. To me, if you're on your bicycle and riding down the street, that's the trend. Which way the wind's blowing, that's seasonality. So right now, the trend is going down the street, but that wind is hitting us right in the face. Historically, data going back to 57, the S&P, the strongest week of the first quarter for the S&P 500 is the first week of January.
Right.
And then we start getting weaker and weaker from then. We actually edge into March, and then the latter part of March is when things get strong again, and April's a very strong month. So we're up against the wind in terms of the trend right now.
I love that analogy. I think you mentioned that last time, John. I made a note of it. I'm gonna have to remember that. I'll give you full credit for that one. That's a winner. So given these conditions with the kind of narrow leadership, but still again the magnificent 7 names just continuing to push to the upside, as you're thinking tactically, as you're thinking of sectors to be focused on or opportunities, do you stick with some of those technology names that feel overextended by a lot of metrics but are still going higher? Or are there other areas where you think are better opportunities here in January?
You know, trying to move away from the XLCs and the XLKs, right? The ones that have been driving the bus here so far. Now you're kind of like, if you're going to try to buy healthcare right now, you're effectively betting on some kind of a correction. And I don't like to do that. I don't like to move. We have a model called the CEF model that actually tracks the money that is moving around the 11 sector spiders. That is still solidly in XLC, XLK, and also financials. So yeah, I don't want to try to get ahead of this by trying to buy the sector that's underperforming right now because I think there might be a correction. I think you've got to stay on the fast horses until they quit, to me, and put everything on a short list and make sure your risk reward when you're putting these ideas on is in order. I mean, I don't think I would be buying tech right now and go on vacation for a month. I think you really have to be on your toes.
It's interesting. Another group you mentioned, financials, one of the groups that you were leaning into. We've talked about insurance names a lot recently, and it's one of the areas. Regional banks, a number of these have had good pops, but insurance, if you kind of covered up the ticker, it would look a lot like a technology ticker. You think it's like a semiconductor or something like that. With some of these areas, financials in particular have started to emerge. Other areas outside of insurance have done better and better. What would you need to see on a chart like this? You mentioned risk management. What would turn you away from a chart like this? Is there a general kind of risk management approach that you would employ in a trend that's worked so well for so long?
Couple of things. I just looked at this chart this morning and I can't remember, but I like to look at the AUM to see if there's money going in there, right? That shares outstanding multiplied by NAV every day, and that gives you a dollar amount for what's in there. You need to look for support. In other words, the first thing that I always ask myself is, what's the risk? How much am I going to risk? I don't like to risk too much more than 5% on any individual trade. So you've got a peak here, David, right? Maybe the middle of December. And you could draw, there you go, a horizontal line. I think somewhere there, if you're going to lean on something, that's where you might put a stop. Just so you can limit your risk. You want to get married to this when the market is so overbought. You really have to be careful, and your risk reward has to be right. So that would be a good place for a stop. And I would make sure that that AUM is expanding on a monthly basis. Because if it's not, if there isn't a steady flow of money going into the CTF, this little pop that we've had is going to die. It's just not going to last.
I have to mention, just switching back to growth, I did my part kind of getting us away from there a little bit, but I keep coming back to some of these names that a lot of people are focused on. Tesla reporting earnings this week. Netflix yesterday gapped higher in a big way on better subscriber numbers. When you're looking at the chart of Tesla, it's very differentiated from the other sort of mega cap growth names. It's sort of like the other one that's trading toward the lower end of the range. Do you see opportunities in charts like this, or how do you think about it when it's testing really more the lower end of the range?
Yeah, it's funny you mentioned that one because you and I spoke about that, I don't know, within the past 6 months, and I pointed out a big trend line in Tesla that went all the way back to 91, I think.
Yeah.
We don't see it on this chart, but it crossed right at that peak that we made in the middle to latter part of December. It actually got up above there for 1 or 2 days. It looked like a breakout.
Yeah.
And then
that was it.
So that trend we're looking at is many years old.
Yeah.
And what you have to be careful of is if we break down through that old low that we made back in November, you've got a whole lot of real estate until we hit the next support level, which is the low from the latter part of April of last year, just eyeballing it, maybe around 150, 160.
Yeah.
So that's the danger. I would not be buying this here unless you love the stock and you're leaning on the lows from November. But this is a trend that was just tested, goes back many years, and it just held again. So this one, I wouldn't come near this unless I had a little element of certainty that it was establishing some kind of a bottom, and I don't see that yet.
Yeah, I remember that long-term Tesla chart. That's a really good one. We only have about 30 seconds left, John, but I'd love for you to answer this one. For those that are just getting into the markets, just learning technical analysis, a confusing time, I'm sure. Any words of wisdom from surviving previous choppy market cycles that they should keep in mind right about now?
I think the best one that's the most basic is know your time frames. If you're new at this and you want to find a stochastic that tells you to buy, you'll find one. It might be a 12-day, it might be a 2-day, it might be a 30-day. So understand what your time horizon is. What's the part of the market that you want to catch? For us, it's 1 quarter or greater, 1 or several quarters. So for our strategic stuff, we're always looking at a 63-day moving average for those kind of indicators. And then your tactical is what's your cadence to get in and out of that bigger trend. For us, it's a month. So we use a 21-day and make sure there's a balance in between strategic and tactical and know what that is. And make sure you're always looking at those indicators through that lens. So you're not dialing the dial on the indicator to give you the answer you want, because it's easy to do.
Great point. I know you do a great job with Asbury Research, John, helping your clients sort of think about the relationship between those different time frames. So I wish you the best navigating these markets as always. Thanks for sharing some words of wisdom with us. Stay warm there in Chicago. We'll talk to you again soon.
Great to see you. I'll see you soon.
That's John Kosar. John's the founder of Asbury Research based in Chicago. Some really interesting points there. His Asbury Six model, I've really enjoyed how he shared that when he's come on the show. Interesting to see how mixed it is, and the things that are less, I guess the things that are more bullish are really driven by trend and the strength in those large, small number of large stocks. The weaker parts are conditions of breadth and flows and other things, which I would argue is still pretty important. So will be very interesting and certainly an area to monitor here in January and going forward. Great take there, as always, by John Kosar of Asbury Research. Now let's get to the 3 and 3, talking about 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. So in the first chart, we have the S&P 500, we have the mid-cap index. So $ SPX in the top half, $ MID, the S&P mid-cap 400 index. When you think about the U.S. equity space, large, mid, small, the SPX, the mid-cap, and the small-cap index, $ SML. What I just wanted to highlight here, and again, the discipline that I learned tells me when the S&P is making new highs and a bunch of other things are not, that is not particularly bullish. Now, the main way I think you need to think about the markets here in 2024, driven by these mega cap growth names is to think growthy, right? So that's why I use an equal weighted S&P 500 and equal weighted NASDAQ as a best, sort of modern Dow theory. But again, I don't see it as a bullish check mark that while the S&P is making new highs, testing 4,900, that is, it's not that bullish, 4,900. You can see the mid-cap, small-cap index all for now putting in a lower high. So, it's interesting to see if this divergence ends up being the end of this upswing in January. At the end of the day, the S&P doesn't care what you think it's going to do, right? It's all about the trend. So I would say if we do pull back 4,700, just the most clear support level, as long as we hold that, things just aren't getting that bad, and the strength in those largest names are still able to hold the market up in a position of strength. Chart number 2, the insurance ETF, ticker KIE. And if you look at insurance, you can see we're overbought right now. I think the chart of insurance represents a lot of what's good in the market right now. As John Kosar and I were talking about, there are a lot of charts that are working. It pays you to, in general, to stick with things that are working, but also recognize when something's a little bit overextended. So you can see we're at the upper end. We're overbought right now. And for me, that tells me two things. Number one, the trend overall is positive, but also we may be a little bit overextended. And usually when we get to that overbought region, it means we're sort of toward the end of that upswing and have a brief pullback. Does insurance and insurance stocks pull back to an ascending 50-day moving average? That might be one of the best setups ever if you're bullish on that space. Finally, looking at the commodity space, I would say crude oil still sideways. I haven't seen enough to really be bullish on it yet, but we're kind of right there at the upper end of that coil pattern that I mentioned. I would say the chart in gold is still bullish until proven otherwise. So think of crude oil and gold almost flipped upside down right now. Crude oil in a downtrend, and then this consolidation. The question is, does it break out? Gold had a rally in the fourth quarter, now consolidating, a bit of a coil pattern here as well. Do we break down $2,000 an ounce and also 1980, which would be the 200-day moving average? Those are the levels I would be watching. Also momentum, right? Look for the RSI to break below 40. A lot of times that can be a good way of confirming that a new downswing is in play. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. A special thank you to John Kosar of Asbury Research joining us from Chicago. Don't forget to like this video, subscribe to our channel while you're here. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.